Have you ever read an article or talked to an advisor or been told by a friend how important it is to stay invested, to stick to the plan, especially during volatile markets? In this video, I want to show you a great article we stumbled across that really shows you how important and how crucial in a lot of cases it could be to stay invested and stick to the plan. Enjoy this video. Welcome to the channel. I'm Logan Sadler. Thank you for stopping by and checking out another one of our videos here on this channel. We appreciate the support. On today's video, I have a really fun one, and I probably say that every week, but I actually really am going to enjoy this video because it talks about something that is very crucial for a lot of you out there. Again, whether you're younger or older, you might really get some benefit from this video. And again, it's never intended as investment advice. I always tell people, make sure you're calling us or meeting with an advisor or meeting with someone about your unique situation because everybody is different. But on this video, we're going to dive into some data. I'll have a little bit of a spreadsheet or a chart to show you guys, and we'll kind of dive through it. But I think you're really going to understand because a lot of you out there have heard how important it is to stay invested in the market during volatile markets. I know I have this conversation with a lot of our clients during volatile markets of, hey, you know what, should we be pulling money to cash or treasuries or annuities or this or that, or should we be sticking to it and looking long term? This video is going to show you some of those crucial decisions and why a lot of advisors and a lot of research shows you need to be very careful when hopping in and out of the market and trying to time things because it can be very hard and in some cases impossible, right? So I want to show you guys this chart. So I wanted to talk about how important it is for some of you out there and what the importance of being invested is. Let's talk about this example over here on the right. So let's say you had $150,000 and some change fully invested of all those days, right? Of all the market trading days. It'll show you S&P average returns from 1993 to 2022. It shows you that if you missed just 10 of the best days of that year, your account would have been only $72,000, which is 54% less than if you would have stayed fully invested for that time frame. The other crazy part is if you would have just missed 20 of the best days of the market, you'd have been down 73%. And you can see here, if you missed just 30 days of the best days of that market, you would be down 83% of what you would have been if you would have stayed fully invested. That is, to me, staggering because so many people say, let's get out while the market's high and when the market's volatile and low, we'll get back in after it recovers down the road. This right here shows you how crucial it really could be to your plan and how much of the returns you might have missed out on to replenish to get back to even and then hopefully start earning again, right? So it shows you over a pretty decent time frame. You're talking about multiple years there, not 5 years, but decades. It's just missing 10 of those best days has a dramatic impact on what the outcome of your investment could be. Now, the other side of that chart shows you good days happen in bad markets, right? So the S&P 500, the best days from 1993 to 2022, it shows you 52% of the best days happened during a bear market, during those volatile times. Then it shows you over there again during those first 2 months of a bull market, right? So it shows you that a very small percentage of them actually happen was once the market starts to get rolling again. And then only about 22% of them happen during the rest of that bull market. So it just shows you over multiple time frames, and again, a long period of time where this isn't guaranteeing anything. This is just kind of going off of some historical data and some estimates here. This is brought to you by Morningstar, is one of the people that was able to put some of these charts together and the data. I've heard this many times from a lot of research and stuff out there, and I thought this did a really good job of just showing you guys how crucial it is to stick to the plan, to understand what are we trying to achieve. And again, not all of you are directly in the S&P. You might have bonds or other investments. We get that. And that's why, again, it's important to understand your situation. But when you're investing in the markets, it's important to understand you're utilizing those for the long-term effects. And it's very important that when you pick an advisor or someone to work with, that you have the right coach that's there to help guide you and give you that advice throughout that process. Because a couple of these mistakes or misjudgments could, as you can see from those charts, could result in a significantly different outcome in your retirement plan. So again, it's always important to understand diversification and other asset classes and all that stuff. And it's also important to understand how the markets work and what the importance can be to sticking in there long term and to understanding your investment objectives and what you're trying to accomplish and how it fits in your plan. So hopefully you enjoyed this video. Again, we always love doing these for you. If you haven't yet by now, go ahead and click subscribe. Give us a like and a comment. Let us know some other videos you might want us to do here in the future. Again, appreciate the support.